Speaking of Alternatives with Keshav Rajagopalan, Managing Director, Head of Strategic Capital Group at PGIM. Private credit direct lending to the lower middle market is an underserved market niche. Success involves knowledge of the client businesses, disciplined underwriting, and attention to detail. Keshav explores the world of private credit direct lending with Tas Hasan, co-founder of Deerpath Capital.
Welcome to Speaking of Alternatives, the podcast where we dig into the many layers of the alternatives landscape. Today, I'm very excited to be joined by Tas Hasan, who's the Chief Operating Officer and co-founder of Deerpath Capital, which is the lower middle market direct lending platform of PGIM. Tas leads the investment team, and very excited to have him today to join us in a conversation about direct lending and everything that Deerpath does in the space.
Thanks, Keshav.
Tas, always love to start by finding out a little bit about you. What brought you into investing, co-founded the Deerpath platform. So tell us a little bit about that story and what keeps you at Deerpath today and what keeps you interested in the investment space.
Sure, this will take me back a few years, but I came into direct lending by accident. Met my partner, James Kirby. He's one of the co-founders of Deerpath. I met him over an interview, and James asked me, I remember this very clearly, what I wanted to do. And I told him what I didn't want to do. I told him, I don't want to wake up at 6 a.m, sit in front of a Bloomberg terminal, read the headlines, and try to predict how the public markets are going to open or how our stock portfolio is going to react to that day. And I remember James responding by saying, you're here to help me build a private credit portfolio. And this is early 2000, so this is a while back.
This is before private credit was the talk of the town.
Exactly. There might have been one or two lenders doing private credit, but most of the hedge fund lenders were doing private credit inside hedge fund platforms, and that's what we did. James and I started working together, and that really allowed us to build a meaningful book of private lending inside a hedge fund platform. And through that experience, we began to see a gap in the market. Just like today, there were strong, growing middle market companies that needed flexible capital, but were not the best served by the traditional banks or the public markets. And that experience became the foundation for the idea behind Deerpath. And you asked me what kept me in the industry, I think is very intentional. The ability to partner directly with companies, provide capital that helps them grow, and build long-term relationships in a market where we think discipline, trust, and judgment really matter. So that's brought me into private credit.
And it sounds like knowing what you didn't want to do helped you get where you are today. What is lower middle market direct lending? I think direct lending comes in different flavors. What do you all focus on, and what's kind of the core thesis of kind of the why?
Very good question. And each lender you talk to will tell you a different definition of lower middle market lending. But the way we think about what we do at Deerpath is very specific corner of the market. And it's firstly senior secured loans to sponsor-backed U.S. middle market companies that are established, profitable businesses, not startup, not venture lending, not distressed credit, not asset-backed subprime loans. The phrase I like to use is the missing middle, and I think that's important. These businesses are often small for the public markets or for the mega lenders that had hundreds and billions of dollars under management. And the traditional banks really have been out of cash flow lending in this segment of our market for a very long time. But this segment is, in any given year, is typically 1/3 of the deal volume in the middle market. It's a large segment. And the way we define lower middle market, that these companies may need a cash flow loan between $50 million and $250 million at 50% loan to value. So they tend to be in the $10 to $25 million EBITDA business. And the primary need for the capital is to fund an acquisition by the private equity fund. Our growth has really been fueled by the stability and growth of the private equity industry, where a lot of the loans used to come from banks back in the days across up and down the capital structure.
Unlike bank loans, PGIM's private credit middle market direct lending often provides a type of value-added ongoing partnership that comes with deep knowledge of this segment of the market.
They're all coming from alternative lenders like us today. The industry has really taken the market share away. And they need a lender that can underwrite the business really efficiently and quickly. Unlike a bank, they want us to stay involved and act as real partners in the growth strategy by funding these add-on acquisitions. I think that's really important.
That missing middle is a great way to put it. How do you find these companies? Obviously, you're working with PE sponsors as well, but how do you find the needle in a haystack?
I think rather than a needle in a haystack, I would think we're a volume business. Last year, we generated over $3 billion of volume. Rather than finding a needle in the haystack, the way we do it is we go out and source a large volume of transactions, over 2,000 transactions a year, and then run it through a funnel. Our funnel has a very specific black box. It's our underwriting criteria. That doesn't change in a given market. The pricing that the market gives us, that would change. But we have our own origination network. We've been doing it for 20 years. We have over 30 people in the investment team, and we have investment team members, originators in major markets and also non-major markets that are directly calling on private equity sponsors. We cover close to 400 private equity sponsors that are active in this space. And we've completed transactions with probably 150 of them. So it's the longevity in the market, the relationship over 20 plus years that now drives constant deal flow.
So it sounds like it's about volume, but then the partnership aspect of this as you think about being there as a solutions provider for different borrowers and your clients. It makes a lot of sense. Talk a little bit about why today. What I really like about the PGIM direct lending story broadly is we play up and down size. We do large cap direct lending, more core middle market. And then I really enjoy talking to clients about the Deerpath capability because of how focused it is and what it can do in a portfolio. But what's the thesis today if you're kind of an investor or client to look at the space?
I think the thesis today is exactly it has been for a long time. What we really are, if you think about it, we're like a bank and we should act like a bank. Our underwriting should be like a first lien senior secured bank. And that opportunity always existed. It's not new. It's not been created overnight. What has happened is the dislocation of the banks over the last 25 years. The banks are really not involved in doing cash flow lending at this size of the market. If you look at JP Morgan, Goldman Sachs, they have large leverage finance teams that are still doing cash flow loans, right? Above the $250 million size. But underneath that, I would say the opportunity exists today because of structural inefficiency, not because there is any temporary dislocation in the market. This market segment is plenty big. In the lower middle market, I would think borrowers need efficient, smart capital. These two things are very important. If I was on the other side of the table running a private equity fund, I would think I would like to work with someone like me on the other end. What has happened over the last 20 years? And the banks really has stopped lending in this segment since the GFC. And many of the largest private credit funds, platforms are built to deploy much larger checks. And that creates this durable gap where experienced lenders can earn attractive pricing while still demanding better terms. So the key is that you can often get lower leverage, better covenants, tighter documentation, enhanced information rights, and a real seat at the table if something goes wrong.
Artificial intelligence is a dominant theme in almost everything these days. While AI might dissuade some investors from software businesses, it's worth delving in with an open mind and an eye for opportunities.
That seems important. It's not just doing the deal, but then how the deal is constructed in the partnership over time. I always like to unpack a headline in these discussions, and there's a lot of media coverage, and it is truly headlines, about AI potentially disrupting software businesses. So as a lender, what are you all seeing in terms of how AI may be affecting software businesses and therefore how it's looking from an overall credit perspective in your portfolio?
Sure. I'll try to answer this question carefully because this is the hot topic today. And I was speaking with a friend of mine that is a long-term investor in software and technology businesses in a large private equity fund. And he said something that I thought was very interesting in our conversation. He said, copying the surface is not the same as replacing the system. And we dug into it a little bit and what that means. And it was a very interesting conversation. So for us, and this is my view, and that's not me saying that we love all software businesses and there's going to be no dislocation, but we think AI is real. But the conversation that is happening around software today is too blunt because there's fear. There's fear. Everybody runs for the hill. And that's where some of the opportunities might exist if you're patient. A lot of debate focuses on what AI can copy, right? The screens, the workflows, the features, even code. But copying the surface is not the same as replacing the systems behind it. In many businesses, the value sits in the boring but durable layers. It's the permissions, the integrations, compliance, the data history, security, collaboration, and then being embedded in the customer's daily operation. It's not easy to rip that apart. And I think that is what matters to us as lenders. We're not trying to predict which AI model wins today. It's going to be very difficult because every day something new comes up. We are asking whether the borrower's cash flow is durable if the technology landscape changes. I think that's the key question. It's not an easy one to answer today. And at Deerpath, we've been cautious about software for a long time, not because we did not like software, because we do not lend to businesses against ARR dreams or top-line growth stories. We're cash flow lenders. So it's not that we avoided because we knew AI is coming. We avoided because we wanted to lend based on cash flows and other lenders were lending against ARR. So I think direct software is only a small part of our portfolio. The rest of the technology exposure is more in adjacent services like IT consulting, implementation, procurement, and managed services, where we still think execution, customer context is still important, even with the advent of AI. I would think that AI will be a major disruptor. There's no question, just like the internet was back in the early 2000s, but it does not disrupt everyday business equally. It will punish weaker products, thin features, and lazy underwriting if you have lent in ARR. But I think it will also do that certain embedded systems and services become more valuable because of advancements in technology. As a lender, what we have always tried to do, and not only in software, is to avoid what I call the blast zone. Stay away from it. Not to win a debate about the future of the software. That's not our job.
That's a good way to put it when it comes to fundamental credit underwriting that you all do. And then, of course, on the AI side, coming back to your volume point earlier, there's probably a supply item here, too. AI will enable business formation. We've seen that in the data today. And as more businesses are constructed, that also then creates earlier in the funnel, certainly, than you all look at, but it'll also create the opportunity for more borrowers in the space as they look to grow their businesses. So there's probably a supply impact as well at some point.
Yeah, I agree with you. And I think, again, adoption of technology sometimes can be good. You know, change is always difficult. It's fear. Change drives fear first before you think about how do you adopt, and how companies that will adopt change, I think they will do better with this technology.
Certainly. To pivot a little to opportunities and challenges, stepping back, you look at the landscape, what excites you in terms of tailwinds? And then maybe what are some headwinds that you're just keeping an eye on from an investment perspective and things that warrant at least some further scrutiny right now?
Sure. I think in terms of tailwind, we think that the structural financing gap that existed in this segment of the market when we started the business 20 years still remains intact. There are many good lower middle market businesses today that existed 20 years back. I think there's more today. It's really 1/3 of what we think the middle market, the overall middle market, is our segment in this 10 to 25 million EBITDA businesses. But not all of them are natural fits for banks or the largest credit funds, because doing a $50 million transaction or a loan does not generate enough profit dollars for large platforms. It just doesn't. We are built for that. For us is do the same kind of deals over the last 20 years. Our credit underwriting box did not change. What changed is we grew by doing a larger volume of the same size transactions. That means grabbing larger and larger share of the market. That has been our strategy, and it remains our strategy. I think we're less than 5% of the market segment in this market, being one of the largest institutional lenders in this lower middle market. But there's still a lot of room for us. And that creates an opportunity for a lender like Deerpath who can underwrite this segment of the market in volume. for institutional investors who always wanted access to this segment, the lower middle market, but there were no one that could do it in volume because it takes a lot of work. It takes the same amount of work to underwrite a $50 million loan versus underwriting a $500 million loan. So you rather do $500 million loan because it's much more profitable for the manager. So I think if you're disciplined, you can still get real covenants, meaningful documentation, conservative leverage, and direct access to the company. You will see that matters when the cycle changes. In terms of challenges, again, competition always existed. If someone says there's no competition in my business, I don't think that's right. The challenge is that success and growth attracts more capital. That has happened in every segment of Wall Street, and it will always happen. However, moving down market for many large direct lender managers is just not about writing smaller checks. It requires the sourcing infrastructure that we've built over 20 years, underwriting depth, portfolio monitoring and management, workout experience, and then the patience to say no. You have to see a large volume. So plenty of capital. Managers are tempted to accept also aggressive EBITDA adjustments. That's one of the challenges. Big features, loose covenants, or lender-unfriendly terms.
That discipline comes so important because there's just irrational actors at some point too, right?
You hit it. And I was just going to say, that's where the discipline matters most. And that's what we've done. We've grown with a lot of discipline in place. You can grow when you build a pyramid. You build it with a large base and slowly move up. You don't build it from the tip.
Expertise in any market can be a critical advantage. Knowing your customers and their challenges and opportunities can help turn risks into profitability. That includes the application of covenants in credit underwriting.
It's a great segue. We get input from our distribution teams on what they're hearing from clients. I want to touch on covenants because that is obviously an important feature of the credit underwriting. What are you seeing in terms of covenants today? You mentioned the discipline point, but what are you seeing and how has the market shifted a little bit in that specific area of a critical part of the underwrite?
Sure. I think in our market segment, there are still covenants. When we mean covenants, they're real covenants. There's a leverage covenant or a fixed charge ratio covenant. And they tend to erode at the high end of the market segment. When you add that 25 million EBITDA segment, obviously the competition starts creeping in and you see some of the asks about covenant light loans or no covenants. So covenants still exist, but yes, we are in certain transactions, we are pushed to do wider covenants. We started with 20%, 30% cushion. I think we're pushed to now give wider covenants, at least in the beginning few quarters. That's the ask of some of the private equity funds. We think covenants are extremely important, not because lenders want to be difficult. That's not the reason. Some lenders use covenant as a tool to extract concessions from the company or take over the business, but that's not our strategy. Covenants are an early warning system for us. They force a conversation before a problem becomes a permanent impairment. That's why you need a covenant in a first lien loan. Otherwise, you rather invest in bonds. They give the lender information rights, engagement rights, and leverage to help shape the outcome where there's still time. And that becomes very important for us. Covenants are part of the bargain. And every single loan we do, if we are lending senior secured capital to a private company, we need the ability to monitor performance and act early. That's one of the ways you prevent losses. It's very important. It's active portfolio management versus reactive. If you don't have covenants, you're just reacting. You're not acting. And without that, you're not really being compensated for the risk you're taking. You might as well invest in high yield bonds.
Maybe a good follow-up here, the types of businesses that you're lending to in that lower middle market space, I assume are pretty sensitive to earnings misses in the sense that there's not a whole lot of cushion always in how they think about it. I know you're underwriting the cash flows, but how does the macro environment and where we are in the credit cycle play into your underwriting now?
So I think there is a misperception that these businesses are fragile or these businesses are smaller and they'll vaporize in a recession. I think that's not correct. These businesses we're lending to, if you think about it, between 10 and 25 million of EBITDA. In other established parts of the first world, they're large businesses.
It's a very attractive business. Fair.
The US is such a very, very large economy that even a 25 million EBITDA business is considered a small business.
Yeah, absolutely. But it's a substantial business.
So that's an opportunity for us. And how we think about it is, when you underwrite for a problem. That's what a senior lender does. That what if, you look at all the what ifs. We're not underwriting with the hope that cash flow is going to get better and let's invest in this business because they're telling us so. I think we look at a business that's been around for 25 years, can show a history of cash flow, has a trend of generating profitability. And based on that, we can give them a moderate amount of leverage. So low leverage is very important. Loan to value is important. High fixed charge coverage ratio right at underwriting is important. So you're building that cushion that if there is a shock that we can't predict, you have enough cash flows to service that loan. And that's how you stop impairment. And then the last but not least, what is very important is having an incented capital provider underneath the capital structure, which are the sponsors. And in our example, that's been extremely helpful over 20 years. And in our segment, the sponsors do put in capital to help the businesses. And in many instances, if we didn't have a sponsor, as a senior lender, we would have to increase our exposure when we don't want to. So we think that having that sponsor is also important. But underwriting, it's don't change your underwriting. We call ourselves a price taker, not a risk taker.
That's a good way to frame it. And maybe as a final question, at least from what our distribution teams have posed, what is that sponsor ecosystem like? Because there's obviously a lot of dependencies on how they're aligned with you. And how have you seen that ecosystem evolve in terms of the partnerships you all have and how you work with the sponsors?
Sure. And I think having a sponsor, we think just calling a loan a senior loan doesn't make it a good loan. So for us, we have our special sauce and sponsor is one of them. Sponsor support, we think that is a plus, but it should not be treated as a repayment strategy. We think it's just one more check mark in that underwriting criteria. And we've worked very well with the sponsor. This segment of the market is very, very relationship driven. And you can see that these sponsors are in their maybe first to the third fund, and their track record is very important. When you have a $500 million fund and you wrote a $50 million check, and then over the next few years, if there was a hiccup, you put in another $25 million to support the business. That's a substantial check for that second or third fund. And they tend to be helpful. They stay involved, and that becomes extremely important. Sometimes we get asked the question, what if the sponsor steps away? The sponsor does step away sometimes. And in our experience, most of the time when the sponsor steps away, they've written several additional checks to support the business. And maybe at that point, that particular investment as a percentage of the overall fund is hitting their concentration limits. And that's when they hit away. But by then, they've already put in substantial capital or paid us down to decrease our creation multiple. Sponsor support is helpful, but it should never be the entire underwriting case.
Very helpful. Well, Tas, this has been a fantastic conversation. Thanks for talking us through how you all think about the space and learning more about Deerpath. 3 takeaways for me as I think about what stood out. One is I really liked your concept of the missing middle. There's a real solution you all are providing and financing real tangible businesses in the economy. So I think that missing middle concept is really important to ground on what the opportunity set is. 2 is your underwrite process. It's all about cash flows at the end of the day, right? So you're looking at that underwriting cash flows, and that remains part of your credit underwriting process and what's kind of the fundamental nature of how you all think about businesses. And 3 is covenants. I like how you framed it's a right to engagement. It's your seat at the table, the information rights, and it's the leading ability to get ahead of something that could then cause a problem. So that engagement right is really important. But Tas, really appreciate the conversation today, and thanks for spending some time with me.
Thank you.
Well, that's a wrap on Speaking of Alternatives. Thank you for tuning in each month over the last several years. I've loved diving deep into the alternatives landscape with you and our guests. As markets evolve, so do we. But this isn't the end of the conversation. In fact, it's just the beginning. The team here at PGIM is hard at work on a new podcast, each episode dedicated to the most compelling investment opportunities of our time and the people bold enough to tackle them. Our new podcast series pivots from specific asset classes to the raw ideas, high-stakes decisions, and the unwavering commitment that drives them, as well as the lessons learned along the way. We'll be sharing additional details soon. In the meantime, be sure to stay connected with us and head over to our sister podcast, PGIM's The Outthinking Investor. Thanks again for tuning into Speaking of Alternatives.
Speaking of Alternatives with Keshav Rajagopalan, a podcast from PGIM. Follow, subscribe, and if you like what you hear, go ahead and give us a review. And be sure to look for the podcast, The Outthinking Investor, also from PGIM. Past performance is not a guarantee of future results. Views and opinions expressed may not reflect PGIM's and are subject to change. This is not a solicitation. Copyright 2026 PFI and its related entities registered in many jurisdictions worldwide. Please visit the Terms and Conditions page on www.pgim.com. PFI is not affiliated in any manner with Prudential plc, incorporated in the United Kingdom, or with Prudential Assurance Company, a subsidiary of M&G plc, incorporated in the United Kingdom.